And welcome back. It's Jason Walter here. I want to talk about early indicators of home buying demand right now because our housing market has been changing drastically because of volatility in mortgage rates and, of course, due to rising home prices over the past several years, though. So in today's video, though, I want to take a deep dive into some early indicators of home buying demand or lack thereof that should give us an indication of where our housing market's headed in the months to come. And with that said, I have a lot of information to share in today's video, and a lot of research went into making this video. So if you guys appreciate that, and of course if you do, please hit the like button. Greatly appreciate that. Also, if you guys are looking for a real estate agent referral, whether you're looking to buy or sell a house in virtually any parts of the United States, then check out that link below, which is homeandmoney.com/Jason to get started today. But I want to share this report with you guys first, though, because this is pretty eye-opening. I was going to share this at the end of this video, but this is a pretty remarkable report here that I definitely want you guys to be aware of in case you guys don't watch the full video here. So if you guys follow the channel, you guys are probably familiar with this graphic here. This is the number of real estate showings in North America according to showingtime.com. In other words, the total number of home showings by real estate agents showing their clients houses for sale. So look at this. This is 2022 in orange. The line just above that is for 2021 last year, and the line above is in 2020. But look at this. For the most recent data they are sharing on their website here, which is for the week ending September 29th, look at this. We have 23.9% fewer real estate showings in North America compared to the first week of January of this year, which is just mind-blowing. Compare this to 2020 this time, we were up 28.6% compared to the start of 2020. And also last year, we're up by 7.3% compared to the first week of 2021. So what a difference a year makes. We're up 7.3% last year, but now we're down almost 24%. And have a look at this because ever since the middle of July, we've had fewer real estate showings in North America compared to the first week of this year, which is just mind-blowing as well. Because if you look at 2020, also 2021, we didn't get into negative territory until we reached the middle of November, of course, approaching the holidays in the winter months here. But we've been negative this year ever since the middle of July, which is vastly different compared to the past couple of years. So that's one of the early signs of home buying demand. One would assume, given the fact we have more houses listed for sale right now, one would assume if we had a strong home buying demand, one would assume we would have a lot more real estate showings. But in fact, we're actually seeing just the opposite. This is because we have approximately 29% more houses listed for sale right now compared to last year. But despite that, we're still down 23.9% compared to January 1st of this year. So that's one bit of information I want to share in today's video, but I also want to go over this right here because this is mortgage application numbers on a national level according to the Mortgage Bankers Association, or the MBA. They actually just announced this on the 28th of September, just a couple of days ago. So mortgage applications overall, which of course includes refis plus home purchases, decreased 3.7% from 1 week ago. And this is for the week ending September 23rd of this year. So total mortgage applications is what's called the market composite index. It's an index based on the total number of mortgage applications, which of course includes refis plus purchases. So overall, it decreased by 3.7% from 1 week ago. And one thing that's not mentioned in this report here, but it's based on my own analysis here, is that this market composite index is at its lowest levels in decades, because have a look at this. This is on the Mortgage News Daily's website here. Again, their composite index, which measures refis plus home purchase applications in the US. So look at this. This is over the past 1 year. Let me just do this. 1 year. The orange line right here is average mortgage rates according to the Mortgage News Daily. So 1 year ago, average rates were at 2.99% for a 30-year fixed rate mortgage. And right now, rates are about 6.7%. Absolutely insane. So rates have more than doubled over the last 12 months. So rates have been increasing greatly, but look what's happened to their composite index. Obviously, it's been decreasing ever since then as well. So of course, when rates increase, refis obviously fall off the cliff. And of course, when rates increase as well for home purchases, that also tends to impact the number of people submitting loan applications for home purchases as well. So the current levels right now at 254.8, that's our index right now. Compare this to 1 year ago, it was 684. Current levels are far below over the past 10 years, excluding the onset pandemic here, which of course was around April and May of 2020. And going back to the MBA's report here, it says the refi index, which of course is a measure of people submitting loan applications for refis, decreased 11% from the previous week and was down a whopping 84% from 1 year ago, which is absolutely insane. And here's a graphic showing that as well. So over the past 1 year, of course, this is this increase of rates, which caused a big decrease in the number of people submitting applications for refis, of course. 1 year ago, their index was over 3,000. Now it's 524. Also, their unadjusted purchase index decreased 1% compared to the previous week, but was down a whopping 29% from 1 year ago. And based on my own analysis here, for this month, which of course is September, we're at the lowest levels in purchase activity since November of 2016, excluding the onset pandemic. But wait, there's more, because their purchase index has now decreased for 10 out of the last 13 weeks. So here's what I mean by that. Their purchase index is at 199.3. This is more or less the lowest levels since the onset pandemic, which of course was more or less April 2020, but excluding April 2020, we're at the lowest levels since November of 2016. Also, as you can see right here, ever since the end of January, their purchase index has been more or less declining. And this, of course, is because of rising mortgage rates shooting up from, what was it, end of January was approximately 3.55%. Now rates are very, very close to 7%. And going back to the MBA's report here, Joel Kahn, who's one of the associate vice presidents of the MBA, had a really good quote that I actually want to read to you guys. It says, applications for both purchases and refis declined last week as mortgage rates continue to increase to multi-year highs, following more aggressive policy measures from the Fed to bring down inflation, of course. Additionally, ongoing uncertainty about the impact of the Fed's reduction of its mortgage-backed securities and treasury holdings is adding to the volatility in mortgage rates. And he's spot on regarding this, because mortgage rates have been absolutely all over the place over the past week or so, and more on that here in just a little bit. It says the 30-year fixed rate was averaging at 6.52%, the highest level since mid-2008. After a brief pause in July, mortgage rates have been increasing. After a brief pause in July, mortgage rates have increased more than a percentage point over the past 6 weeks, which is absolutely insane. With rates now more than double what they were 1 year ago, the pace of refinancing is running at a 22-year low. And meanwhile, out of all the applications for mortgages right now, approximately 30% are coming from refis, and therefore approximately 70% are coming from purchase applications. Now, here's another interesting trend you guys should be aware of as well. It says with the recent jump in rates, the ARM share, which of course are adjustable rate mortgages, the ARM share reached 10% of applications and almost 20% of total dollar volume of applications right now. ARM loans remain a viable option for qualified buyers in this rising rate environment. I would say be very careful. So ARMs tend to be much more risky compared to a 30-year fixed rate mortgage. For a 30-year fixed, obviously your payment and your interest rate is fixed for 30 years. For ARM, your rate is only fixed for a short period of time. It can be 5 years, 7 years, 10 years, and possibly even more than that. But after that time where your rate becomes variable, it adjusts to current market conditions or current mortgage rates. And therefore, your housing payment is not fixed over 30 years because of this variable rate after that short-term fixed rate portion. Another thing I want to mention regarding this is that the ARM share at 10%, the all-time record high this year was around 12%. We started the year at approximately 3%, so the current levels right now are more or less 3 times the levels we saw in January, and this of course is due to sky-high mortgage rates. So have a look at this. The 30-year average mortgage rate, according to the MBA here, with conforming loan balances, that means loan balances of $647,200 or less, is averaging at 6.52% right now, but this is paying a 1.15 in points. So in other words, in order to get this rate at 6.52%, you have to pay approximately 1.15 percentage points in order to get that rate here. And this is also for 80% loan to value ratios as well. What this means, of course, is that you're financing approximately 80% of your home purchase and you're putting down 20% as your down payment. So the reason why we're seeing the ARM share of activity increasing is because average rates at 6.52%. They're also calling for a 5-1 ARM, meaning it's fixed for 5 years, then it becomes variable thereafter every single year, is at 5.30%. And that's paying 1.28 percentage points for points. Also for 80% loan to value. But look at this, 5.30% compared to 6.52%. Obviously, it's going to be enticing people to use a 5-1 ARM, for example, versus a 30-year fix, given the fact that your housing payment would be a lot less at 5.3% versus about 6.5%. So the Mortgage Bankers Association is stating that the spread between a 30-year fix and a 5-1 ARM is approximately 1.22 percentage points, but this is actually higher compared to what the Mortgage News Daily is reporting as of today, because right now, which is the 30th of September, they're reporting that average rates right now for a 30-year fix is at 6.79%. Again, these are national averages for people with exceptional credit. Compare this to a 5-1 ARM, they're stating that rates are at 6.05%. So of course, far less than 1 percentage point difference here. But take a look at this, because if you have a $400,000 loan balance, your housing payment, which includes only principal and interest, would be $2,605 per month for a 30-year fix. If you're going to get a 5-1 ARM at 6.05%, your housing payment would only be $2,411 per month. In other words, in this example here, you would save approximately $200 per month in order to get a 5-1 ARM versus a 30-year fixed. And of course, because you save money on getting a 5-1 ARM, that could entice people to use a ARM product rather than a 30-year fixed rate loan. I also noticed that the Mortgage Bankers Association also released application volumes for brand new houses. This was announced on the 20th of September here, and this is based on a survey regarding home builders across the United States for August 2022. It says mortgage applications for brand new home purchases decreased by 10.1% compared to 1 year ago. However, though, compared to July 2022, which of course was the previous month, applications increased by 17%. So it's pretty astonishing that even though we have an increase of 17% compared to July 2022, we're still down by 10% compared to 1 year ago. But as I mentioned in my video from a couple of days ago, one of the reasons why we saw an increase of applications and also home sales for August compared to July was due to lowering of mortgage rates. So rates actually decreased from the highs we saw in mid-June of this year through basically the middle parts of August of this year. And that caused an increase in the number of applications for brand new houses and also for the number of contracts signed between home buyers and home builders as well. And check this out, because the MBA estimates that new single-family home sales, which has been consistently a leading indicator of the U.S. Census Bureau's new residential sales report, is that new single-family home sales were running at a seasonally adjusted annualized rate of 690,000 units in August 2022. And by the way, this was reported on the 20th of September, which of course was before the U.S. Census Bureau reported new home sales for August. And this is actually derived from data from their survey here, their builder application survey. So more or less what they do is they look at the number of applications for brand new home purchases and take that information and forecast for home sales for the month. So if they see a giant increase of applications for brand new houses, they're assuming they're going to be seeing an increase of contracts being signed between home buyers and home builders. What's really interesting to me regarding this is that their estimate at 699,000 new single-family home sales, and of course that's a home sale, which is of course when a contract signed. So for 699,000 for August, that's very, very close to what they actually received here, because according to the U.S. Census Bureau, as of August, they actually had 685,000 home sales on an annualized basis. And this again is for newly built single family houses in the US. So 685,000 on an annualized basis here is very, very close to their expectations for 699,000, which is pretty impressive because the street was forecasting for only this. The forecast over the street was for only calling for 500,000 home sales on an annualized basis. And again, the actual number was 685,000. So of course, the street was way off at 500,000 for the forecast, but the MBA was very close at 699,000. And by the way, I made a separate video regarding new home sales in the US a couple of days ago. If you guys haven't checked that out, then please do so. I'll also try to leave a link below for you as well. But in going back to the MBA's report here, it says that new home purchase applications were down year over year, but rebounded in August after 4 consecutive months of declines. Despite higher mortgage rates, I would say though, the mortgage rates were actually at below levels compared to the mid-June of this year. Actually, let me just show you really quickly here. As of mid-June, the average rates were at 6.28%. They actually decreased all the way until we hit the 1st of August when rates were averaging at 5.05%. And rates in August really didn't get above 6% for the entire month. Average rates were more or less below 5.5% for the first 18 days of August. And this, of course, is why we saw an increase of applications, but also due to the fact we saw an increase of home sales for August as well. In any case, going back here, it says after 4 months of consecutive declines, we saw an increase of brand new home sales in August. We also have a declining home builder sentiment falling for 9 consecutive months. So every single month in 2022, home builder sentiment for building newly built single family houses has declined. So it has declined for 9 consecutive weeks. Also, we have looming economic uncertainty in the US as well. The average loan size decreased also for the 4th consecutive month as well, which is a sign of slowing home price growth in the new homes market. Also, between moderating sales prices and volatile mortgage rates, buyers seem to be biding their time. The MBA also estimated that for August, brand new home sales for single-family houses increased by 18% in August. And actually, we're very, very close because the actual numbers were right here. Home sales increased in August by 28.8% compared to July of 2022. So their forecast for a jump by 18% in August was actually very close. However, though, the current sales pace for August is still 23% lower than the November 2021 peak, though, and is still down 20% from last year. And by the way, by product type, which of course means by loan type, conventional loans compose of 72.1% of total loan applications for brand new houses. So the vast majority of people are using conventional loans to buy houses right now, or new houses right now, at 72%. FHA loans only made up 17% of applications, and USDA loans compose only 0.2%, and VA loans represented 10.7% of total applications. And also the average loan size of new homes decreased from $416,000 in July to $415,594 in August. And with that said, please comment below with your biggest takeaways from today's video. Also, if you guys got any value in this video whatsoever, then please hit the like button. I greatly appreciate that. Hope you guys have an awesome day and look forward to seeing you on the next video.